Hi, this is Drew Erickson back again talking about money, not math. I hope everyone's having a great day and gearing up for a great weekend. In today's conversation, I'm going to highlight an article titled Three Retirement Planning Blunders That May Cost You a Fortune by Katie Brockman on Fool.com. All right, so it's a pretty short article, so I'm going to read most of it and then I'll react as I'm going. Hopefully you can tell when I'm going in and out of reading versus my own reactions. But as always, I'll include the link to the article in case you want to read it yourself. So she starts out by saying, one of the toughest aspects of retirement planning is that nobody has all the right answers. There's not necessarily a correct answer to exactly how much the average person should save or what age is best to retire, because it will depend greatly on your unique situation. Even though there's no single right way to save, there are a few wrong ways to prepare for the future. Some retirement planning mistakes may seem harmless at first glance, but can actually cause a significant amount of long-term damage. The good news, though, is that the sooner you catch these blunders, the easier they are to correct. I forgot to mention this before I started reading, but I really enjoy this article, so I strongly recommend listening all the way through because I think it'll really bring you value, and if you believe what I believe, it's going to give you some things to think about. All right, so number one, she says, forgetting about how taxes will affect your retirement income. I'm going to say that again because it's extremely important. I think it's the most overlooked part of financial planning that almost anyone I've ever talked to is affected by. Number one, forgetting about how taxes will affect your retirement income. If you're investing in a tax-deferred retirement account like a 401k or traditional IRA, you won't pay taxes when you make the initial contributions, but you will owe income taxes when you start making withdrawals in retirement. And if you haven't accounted for these taxes in your retirement plan, that could throw off your whole financial future. Not accounting for taxes could lead you to withdraw more than you should from your retirement fund each year, which may result in running out of money sooner than you anticipated. And if you expect to spend more money usually or annually in retirement than you do now, you may push yourself into a higher tax bracket and owe Uncle Sam an even bigger chunk of money. All right, stepping out of reading for a second. Something I forgot to mention, but I want to add, in addition to 401ks, traditional IRAs, other tax-deferred things are 403bs, pensions, TRAs, basically a majority of anything government-related or group-related. If it doesn't say Roth, it's probably tax-deferred, okay? Especially if you're locking up your money, whether it's defined contribution or defined benefit. The other thing is they say if your income is higher in retirement, you may have higher taxes. But also keep in mind that Uncle Sam, aka the IRS, aka our government, has the right at any time to vote to increase or decrease taxes. And if they increase taxes, whether your income goes up or down or not in retirement, your retirement tax liability will likely go up. All right, so going back to the reading. In addition, you may have to pay taxes on your Social Security benefits too. Depending on where you live, you might owe taxes on your benefits at the state level. Additionally, you may also have to pay federal taxes on your monthly checks if your income reaches a certain level. For unmarried individuals, you'll pay taxes on up to 85% of your benefits if you're earning more than $34,000 per year in combined income, which is half your annual benefit amount plus any other retirement income you have. Married couples can expect to pay up to taxes on up to 85% of their benefits if their combined income is more than $44,000 per year. All right, that paragraph is so important. I'm going to read it again. For unmarried individuals, so single people, you'll pay taxes on up to 85% of your benefits. Again, keep in mind you pay taxes on your Social Security contributions on the way in. So if they tax it on the way out, that's a double tax. If you're earning more than $34,000 per year in combined income, which is half your annual benefit amount plus any other retirement income you have. Married couples can expect to pay taxes on up to 85% of their benefits if their combined income is more than $44,000 per year. Between income taxes on your retirement and account withdrawals and potential state and federal taxes on Social Security benefits, that's a lot of retirement income you won't be able to spend. And if you're not prepared for those costs, you could be in for an expensive surprise. All right, number two. So also, I want to ask you, and obviously I can't hear your response, but if you're single, do you think $34,000 per year is a lot of money? Or if you're married, do you think $44,000 per year is a lot of money? Well, if you don't, the government obviously does, and they think that because you're over those thresholds, that it's okay to double tax you and give it to someone else who hasn't planned. So make sure you're aware of where you're putting your money today is going to affect you in the future. And yeah, so I'll just move on from there because I'll probably go way too far down that rabbit hole. But number two, not considering how much you're paying in retirement account fees. Whether you like it or not, you're paying fees when you invest in savings in your 401k or IRA or other retirement accounts. However, not understanding what you're paying in fees can be incredibly costly, because paying even a fraction of a percentage more than you should amounts to tens of thousands of dollars over time. The average 401k plan charged fees of around 1% of total assets under management, according to a study from the Center of American Progress. So if you have $100,000 in your retirement fund, 1% in fees amounts to $1,000 per year. Over a lifetime, the average worker paying annual fees of 1% will end up paying more than $138,000 in fees alone, according to the study. But if that same worker were paying slightly higher annual fees of 1.3%, that number increases to more than $166,000 in fees over a lifetime. To figure out what you're paying in fees, dig through your plan statements to look for the expense ratio, which is the percentage of your funds devoted to fees. And if you can't find that number, talk to your plan administrator or whoever you trust for your personal financial planning needs, because keep in mind that your group 401k plan or 403 or whatever you use, their plan administrators are only administrators for that plan, not your overall financial plan as a whole, okay? So just keep something to keep in mind. There's a difference between your 401k plan advisor and your like a personal advisor that takes everything into account. So if you find you're paying higher than average fees, consider switching to less expensive retirement account. But if you're investing in a 401k that offers employer matching contributions, you should continue saving enough to earn the full match. Free money outweighs high fees, so it's a good idea to allocate at least a little money there. After you maxed out the match, you can consider investing the rest of your cash in an IRA or other tools. I'm going to add in, she doesn't say that, but I'm going to say in an IRA or other tools with lower fees. Number three, choosing the wrong financial advisor. All right, so I'm not going to read through this because I know I'm getting pretty long in the tooth here with my reading, but basically she talks about her recommendations for CFPs and CPAs and all these different things. For me personally, I'll just admit and say that I'm not personally a CFP. I have considered getting it over time, but I think the biggest thing that I would recommend is just finding someone that you trust, that believes what you believe, and is willing to take the time to explain how where you're putting your money today is going to affect you in retirement, not just sell you on rate of return. All right, because the reality of it is rate of return is one piece of the story, but it's not the whole. It's not the whole thing. All right, so that's just my opinion, my recommendation. At the end of the day, it's completely up to you what you decide to do. I hope this conversation brought you value, and please let me know what you thought, or if you have recommendations or questions. I always really appreciate hearing from those who are willing to take the time to watch and listen to my conversations. And if you like the conversation, please share it with a friend. Thanks again for taking the time to watch or listen today, and I hope you have a great weekend. Thanks, and bye.